Good afternoon, everyone. I'm Dominique Velger. Thank you so much for joining us. And I'm here joined by my colleague, Terrence Bazil. He's our community engagement specialist. And we also have Wendy Mateo Arias with us from Children's Hospital. Thank you so much for joining us, Wendy. All right, we're going to get started. Before we get started, I wanted to let everyone know that we will be reducing the background noises. So if you have children or pets barking in the background, don't worry. We have those muted. And then please use our questions feature. So if you have any questions, we'll love to answer them throughout the presentation. And also wanted to remind you that the presentation is being recorded. So if you miss a portion of it, or if there's something that you want to play all over again, you can watch it on our YouTube channel at MyHUECU. And then also at the end of this workshop, we'd like for you to take a survey. Just let us know how we did. So, we can improve and just get better for you. We're going to go off camera and we will get started momentarily. First, I wanted to talk to you about the difference between the credit union versus a bank. First of all, we are not for profit, but we operate just like a bank. We provide you with, all these different services, ATM machines. We have checking, savings accounts, and we also basically exist solely for the purpose of our members. If we have any savings, we pass it on to you, and we do a lot of community engagement. And then you can access us anywhere at any of our locations online. But of course, we'd love to see your beautiful faces in person. So you can come anytime to any of our branches. And speaking of branches, we opened one a little bit ago, I would say, November, October, back in around the LMA area, which is the Longwood Medical area. We're right underneath the Jostin Diabetes Center, that same block where you have Sweet Green. So if you happen to be in that area, just stop by, see us, and see how we can assist you in any way. Okay, this presentation is about credit. How does credit work? So one of the things we want to show you, give you are some tips to kind of help you on your financial journey. So people normally talk about credit or they don't even realize the impact that your credit score has. And that means, are you going to get a better rate or better loan than the person who has not such a great credit score? So the best credit scores to have, the higher ones, it's between 720 and 850. So for example, if you were going to get a loan, your interest rate for that particular loan, let's say $10,000, for example, it would be like 4.23%. So your monthly payment would be $741. So the lower end is anything between 500 or 500 or less. And I'll give you an example. I work with this young lady, and she said, "Oh my goodness, my credit score went up." And I was thinking, well, goodness, there's a magic. What's going on? Let me know the difference. She said, "I'm making my payments on time, so my score is up." And I was just thinking, oh, I thought you're supposed to do that. So she didn't realize that by her not making her payments, it was taking a ding on her credit score, because she just would make it whenever she felt like it. So those little things definitely impact your credit score. So you want to make sure, you kind of check in at least a couple of times a year to see what your credit score is and what's going on with that.
Thanks, Dominic. I also want to add in a little bit more information to that. I also want to communicate that this credit score, wherever you're at right now, is not where you will be forever. It's just a reflection of your credit report, your payment history, and a couple other things that we will touch on later throughout the presentation. And the impact of your credit score, even if you may not fully understand it, is that the higher the credit score, as Dominique mentioned, you are able to access better favorable rates in terms of loans and whatnot. And Dominique did a great job explaining that. Now let's keep going. And I also want to touch on the additional cost of having a higher credit score compared to a lower credit score, or the additional cost with having a lower credit score as opposed to a higher credit score. It does equal a higher cost and interest, especially year over year. And no matter where you are now, you are able to boost up that score with some good financial habits, and you're able to refinance the loan that you're currently in if you're not at the credit score that you want to be. Just taking it a step further, let's look at what is credit versus what is not credit. Credit is utilizing a loan now and paying it over a period of time based on a set interest rate and time frame agreed upon by the lender at the time the loan was dispersed. What credit is not is cash. Debit or any kind of debit card that you're using, where the funds that you are using to pay for those goods.
Hi, everybody. We might be
Services
having
that you're
some.
receiving right
Oh,
now, that's your
okay.
money. That's money that you've earned through a pay. Um, Anything that you have made some money with over time. And credit is more those credit cards, those auto loans, a mortgage, any position where you've been given a pretty decent amount of money up front and you're paying it back over time. And that monthly payment history is really going to be a critical factor in determining that credit score. Anything you want to add, Dominique?
Yes, so you want to make sure, you check in just even to see where you are, if there are any changes or any kind of thing, reports that are not accurate, so you can stay on top of your credits, and any kind of credit score that you have out there.
Awesome. Now for
And when
the, oh, you can take it, Dominique, go ahead.
All right. And your credit bureaus will also help you figure out what you have going on, like the Experian, TransUnion, and Equifax. They have different information about you. So you want to reach out to all of them just to see, okay, where do I stand? What's going on with my, credit score? And then all of them really could collect different information about you, whether it's, utilities, or if there's any debt collection that's out there with your name on it. You want to make sure, okay, I paid that a long time ago. This is inaccurate, so you can also fix it. And then also individual consumers, they all have different creditors and different lenders that have these different informations about you. Like it could be, the National Grid. You could have they have something on you, so you want to make sure that, okay, this is not accurate, or this it is accurate. Let me pay it off, and then get that off your credit report. Anything else you'd like to add, Terrence?
Actually, no, I think that was perfect.
Okay.
Let's see, credit reports, and I'll take this one right here. So credit reports and credit scores are two different things. Credit reports are very similar to the time when you're in high school or in college to a transcript. It's going to show all of the open classes you've taken in terms of the high school and school scenario. But on your credit report, it's going to show you all of the different lenders that you've interacted with, all the different accounts that you have open, all the debt, your payment history, when anything has been opened or closed, anything in collections as well. So it's going to give you a very, very detailed report of everything that you've done in terms of credit, and even utility payments or their phone payments can potentially show up on your credit report, even if it may not directly report to the credit bureau. We'll talk about that a little bit later. And things in collections, such as those medical bills that could potentially end up in collections, will also show up on that credit report as well. It's a great way to protect yourself and to also review the credit report on a pretty regular basis. So that way you are able to ensure that there's no incorrect reporting, any accounts that are open that you don't recognize, or you want to ensure that the information is accurate. And if it's not accurate, you really want to catch it sooner than later. So that way you're not suffering the effects of having compromised information. And the best place to request your credit report is annualcreditreport.com. And I'm actually going to paste that link in the chat while Dominique will tell you a little bit more about annualcreditreport.com.
All right, thank you so much, Terrence. So with the annual credit report, it's a safe website. So let me emphasize that, because there's just so many fake ones out there that mimic themselves as the real thing. So you want to also make sure, like, but before you see it, when you look at it, if it has HTTPS, that means it's accurate. If it's sometimes they kind of mimic it, you got to make sure that it's the right one, so you won't click on it. So you got to get that credit report. You look at it, you analyze it. You want to make sure everything is accurate, because a lot of times, I know for me, I've had a couple of mistakes on my credit report. It was like a gym membership from like a long time ago, and I went to purchase a car and it was popping up and showing up like I didn't pay, and I was like, wait a minute, 1 second. So you want to make sure that that is accurate, so that if there's any issue, like you want to make a major purchase, it's not going to impact you, like we talked about earlier, in terms of the rate that you're going to get for that particular loan.
Awesome. Thank you, Dominique.
Mhm.
Now we're going to take a look at a simple credit report, and I'm going to take my time and really drill deep into this for the sake of understanding and ensuring that we communicate all information accurately. So this is an example of Harvard University's employee. It's completely blocked off, and this is an account that was opened on 2003. There's a high credit limit, which shows you what the high balances. So this is where your limit is. You don't want to go above this, where your current balance or the highest balance that you had, the status date as of 2017, any amount that were past due over here, last pay date, and your scheduled payment to this number right here, scheduled payment. When you are applying for loans in the future, especially mortgage loans or looking to get anything substantial, they will look at this scheduled payment in terms of determining your debt to income ratio. So if you are making, let's say $150 of a payment or even $200 per month, that's great. That's phenomenal. That's going to help you pay down the balance faster. However, in terms of what you are obligated to pay and what number you have to have a minimum payment per month, it's $127. And this will be calculated and added with your other loans that have a minimum payment to determine, okay, 127 plus 130 plus 150 equals X, and that is your current debt. It'll also show you your current balance as of the reporting of that month. This person has a balance of $4,216. They're very close to that high credit limit, and this will play a factor later in determining your credit utilization ratio. You want to keep that credit utilization ratio below 30%, and we'll talk about that a little bit more. A bit more about the sample credit report is you see these C's here. C in January, C in February, March, C, 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 C. What this C means is that the payment status is current, which is great. It means that they're making their payments on time, they haven't been late, and it goes back as far as 2015. And this is a phenomenal payment history. What you don't want to see is a delinquency. You'll see here, it'll say 30, 60, 90 plus. This will actually reports how many times you've been 30 days late. It'll say 1 here, how many times you've been 60 days late, 1 here, how many times you've been 90 days late. And these will show the lender how reliable you are in terms of making your payment in full and making it on time. And this will stay on your report for the last 7 years, and it really does make a impact in terms of determining your credit worthiness for future loans. It'll also give you some information about the account type. This is a credit card, it's revolving, and we'll talk about revolving loans, installment loans, and a good mix of what types of credit you need to have and what types of good credit to really have in terms of having a good, healthy financial credit review. And we'll take this a step further. We'll look at a different credit report. This is Comcast, as I mentioned before. It may not always be a credit card account that you open that will report to your credit bureaus. It may be a utility bill like National Grid and Dominique mentioned before, or it even could be a cable bill. This is actually reporting because this is a collection. This member opened this account back in 2015, and the original amount is only $310. And in this instance, I'm a bit more familiar with it, is that this member actually forgot that they had this unpaid balance with Comcast, and they kind of just kept going about it. And all of a sudden, it showed up on the credit report. And when they went to apply for a loan, they showed up and said, hey, this is seriously past due, and they were denied for it. So what you can see here is this did not just go 30, 60, 90. This went really far and went straight to derogatory. And it's been that way since, it looks like December of 2015. This is a very small balance. This is something that could have been taken care of very quickly, but this member was not paying attention to their credit report. And when this was reported, it continued to report until it came time to get that new loan. So this is another factor, another reason why you should be reviewing your credit report on a pretty regular basis to ensure that everything that is reported is accurate and that there's nothing that you're missing, that is some for some reason or whatever, we all are very busy. We're trying to keep things going and keep our day-to-day going, but setting up some time to review that credit report could potentially save you thousands and could potentially also help you get those loans out, especially when you need them. You don't want to all of a sudden be in constraints and you're looking to get a loan, and all of a sudden you realize, oh, hey, you've had this Comcast bill that's been delinquent for the past year and a half or 2 years, and now you're denied. It can be fixed. It's 100% possible to clean this up. However, it does take some time. And the best way to avoid that is by staying on top of it and doing frequent reviews to ensure that the information reflected on your credit report is an accurate representation of what you have been doing yourself. Anything to add, Dominique?
No, that's accurate, but because after that situation with me and that gym, I'm always trying to look to see if there are any errors so I can fix it immediately because it
Awesome.
can really trip you up when you least expect it.
Of course. And next is credit report timing.
Yes, so imagine, you want to make sure that a lot of times these credit report timing, like if you close an account, and it in good standing, those things kind of stay in your report for 10 years. And then there are different if you file for bankruptcy, there are different ones. Chapter 13, Chapter 7 stays on your credit report for 10 years, and the other one stays on your credit report for about 7 years. Any kind of late or missed payments, 7 years. Any kind of tax liens or any kind of credit inquiries, like for example, if you're buying a house and they or like you're trying to open a credit card or something, those inquiries stay. But those are really, it doesn't really hit it like it's not a big dig in your credit report, but the other ones will stay there. So if obviously if it's in your account is in good standing, it stays there, and that helps you in terms of getting a loan and getting a good rate on your loans as well.
Mm. I also want to add in that some of these will remain on your credit report for different times, yes, and you really want to look at the impact that they'll have on your credit score. Credit inquiries will stay on your credit report for 2 years, but it doesn't mean that they'll have the same impact on your score for 2 years. There's also some tips and tricks that you can do with inquiries. You don't really want to have too many inquiries, and you will. It's a bit of a catch. If you are looking for loans, especially a new mortgage, you really want to have all your inquiries happen within a 2-week period, so 14
Mhm.
days. And what that does is that lets the credit bureau and the lenders know, hey, this person's shopping around, many people be pulling their credit. That's great. What you don't want is to be every single month having a new credit inquiry and it continues on that way for some time because those inquiries will start to add up and they do show that you are appearing desperate for credit and you are having some financial constraints, and it may not be wise for a lender to lend to you at that time. And it could potentially do some pretty hard damage to your credit report. That's only if you are consistently having new credit inquiries and a hard inquiry, not a soft inquiry. Soft inquiries affect your credit report differently. And hard inquiries are the ones that they're a lender and they're saying, hey, we're going to pull your credit. And that does become a hard pull.
Mhm.
Now, if you do come across some errors on your credit report, there's a few different ways to dispute the errors. What you want to do is first contact the 3 credit bureaus, either Experian, TransUnion, or Equifax. I do also want to note that there's more than 3, but they're the 3 main ones. Not all information reported to the credit bureaus may be reflected on all 3. And that is up to the lender to decide who they will be reporting to. As an example of this, if you're looking for an auto loan, most auto lenders that I've interacted with personally use TransUnion and report to TransUnion. And if you pull an Experian report, it doesn't mean that your auto loan may not be there, but it may not have the most accurate, up-to-date information, while a TransUnion report might actually have the most up-to-date information. Um, and it also is, again, dependent on the lender. Maybe if I'm a small business or it's a small store credit card, they may not be able to have the fees to, or the funds to report to all three. And this is another reason why you should be constantly looking at all three or just doing a quick review to make sure everything is going on. And if errors do show up, you may not catch it on Experian, but you catch it on Equifax. And the best way to do that, first, contact the credit bureau. If you contact them and you're waiting to hear back, you can then contact your lender to ensure that they are catching a record of all your payments. We're all human. Lenders are human. Credit bureaus are also human. If there's a mistake, please feel free to visit consumer.ftc.gov for sample letters to see, hey, how can I possibly do this? How can I fix this? And most likely lenders are willing to investigate and correct the errors if you do bring it up to them. And follow up. You may need to ensure that your name stays front of mind, top of the list, so that way your information is correct. This credit reporting FICO score, that it's yours. And you need to ensure to do everything in your power, and you have the power to ensure that everything is accurate, is correct, and if something is misrepresented, it is your job to fix it. Anything, Dominique?
No, it's true. You have to stay on top of it because you don't want to depend on just the credit bureaus to have that kind of information because yeah, like Terrence says, we're human, they're human too, because it's the humans putting that information and data in there. So you want to make sure that it's accurate and or there's an issue and you want to fix it right away.
Another thing you want to be on a lookout for is any loans that appear on your credit report that don't appear to be correct or yours. And this could be an instance of your information being compromised. And
Yes.
yes, and this is kind of scary. And the best way to fix this is by placing a fraud alert or fraud or credit freeze.
And that usually happens like with identity theft. Someone may have stolen your wallet or your purse and they have access to your social or any kind of, pertinent information where they can open up credit cards or loans under your name. And then you don't realize it. By the time you realize it, you're like, oh, wait a minute, I got to do something. And this is when you do an alert or a credit freeze.
A fraud alert will note what it does is it requires the lender or whoever is pulling your credit to do extra necessary security steps to verify and identify that the person requesting the credit is in fact you. How you do that is you contact each of the credit bureaus, TransUnion, Equifax, and Experian, and say, hey, please set up a fraud alert. And when all that does is, hey, whenever there's something new happening, please let me know. There is a time limit with this. Sometimes the alerts can last for 90 days, sometimes up to 1 year, and it's not forever. That's what the main thing I want to communicate. You might have to keep this going, and it usually happens after something has appeared on your credit report that you realize, hey, this is not accurate, and you automatically put a fraud alert. Well, not automatically, you have to request a fraud alert. There's also a credit freeze, and a credit freeze is a next step up in terms of security to protect your credit report or credit history from being accessed. And it stops everyone, all lenders, from opening anything in your name. There is a bit of an extra step in terms of when you, the accurate individual who you are looking to open a new line of credit or apply for a loan, you do actually have to unfreeze it for a time and allow the lender to pull it. But it's the most safest way available right now to protect yourself from incorrect information, identity theft, identity fraud, especially right now during this time of inflation. There's a lot of scams and fraud out there. And one of the best ways to protect yourself is a credit freeze. And to do that, you would have to go to each individual bureau on their website. You can either call in, or on the website, you can even mail a letter if that's what you want to do, and request a freeze. Yeah, and what this does is just protects you and ensures that nothing new can be opened in your name. Now, managing your credit score. Oops. Managing credit score, I do want to say something a little bit here. You are able to have you have the most control over your credit score than anyone else. You are able to do a little bit of tips and tricks, and in terms of your payment history, managing different things, the power is in your hands. And if the credit score you have right now is not what you want in the future, you 100% have the ability to change it. And if you feel like you're drowning, you're in debt, you feel like nothing's going to happen, there is hope. It's not set in stone. You can 100% start incorporating some new habits financially
Mhm.
to improve your credit score and get control of it and really get the score that you would love to have. Um,
Absolutely.
mhm.
I can also share an experience with me. A few years ago, I got laid off from my job, and of course, there are some. I made payments, but sometimes you're going to make the late payments, and that will definitely have an impact on your score. Was I down on myself? Oh my goodness, absolutely. So don't beat yourself up, because you can dig yourself out of it and get to the other side, because it's a constant revolving door, and you're all constantly working on yourself, and you want to know, okay, this is not where I am today, is not where I'm going to be tomorrow, and so on.
Um, and a great resource that we offer free to our membership and free to those on this presentation right now is one of our partners, GreenPath, and they offer Learning Lab Plus, which is a free online educational portal where you can learn different tips and tricks, making the most of your money, the A1 credit tool, and paying down your credit card debt. This is a completely free resource where you can take the time. It's self-user paced to learn different skills and become a bit more familiar and financially well in terms of information. So that way you can start to incorporate some new habits into your life. I'm going to put that link in the chat right now as Dominique goes into what is a credit score.
So a credit score, we were talking about before, it's managed by the three credit bureaus that we talked about, and then FICO score as well as Vento score. They're the ones who kind of figure out, okay, Terrence or Dominique, they've been doing their payments, paying off their different loans. And so then they kind of put you in that category between, 700 plus. And then, the average scores between 650 and 749, and then the scores, if it's under 600 or under 500, again, work in progress. Where you are today, you're not going to be there tomorrow. So I say, be kind to yourself. So it's just a gauge. At least you get a sense of what it is, what the credit score is, and what you can work towards to get yourself to that higher credit score. Of course, because it will help you in terms of getting a better rate for any loans that you may have or may want in the future for cars or a big purchase like a home or something like that. And then also even credit cards will not charge you as much if your credit score is higher as opposed to someone else whose credit score is lower. So you want to make sure you stay on top of that as well.
Awesome. I also want to mention that credit scores and credit reports are two very, very different things. Credit reports are managed by the bureaus. However, credit scores are independently managed outside of the bureaus, and you'll find the FICO score and the Vantage score. There's two different things, and so as I talked about earlier, the credit report is more of a transcript. We'll show all of your classes, what you took and whatnot. Your credit score is your GPA, just a number, and it doesn't give as much detail as far as your credit report will. So it's not going to show if you made all your payments on time. It's not going to show who your different lenders are. It's not going to tell you which months you did or did not make payments. It really is just going to be three different numbers. That's going to be a quick snapshot of, okay, boom, This is what Terrence's score is. It is up to the lender and you, if you want to dig deeper to learn a bit more. Now, how a FICO score is compromised and what makes up a FICO score. FICO score is broken up into 1, 2, 3, 4, 5 different factors. And these different factors are payment history, your length of credit history, your credit mix, amounts owed, and new credit. We're going to start with the biggest one right here. And this percentage, right, 35% is payment history. Now, what does that mean? That means the biggest, most impactful portion of what makes up your credit score is your payment history, and that's on-time payments every single month. And that is paying it in full and ensuring that it's current, making sure you have those C's that we saw in the credit report. If you don't currently have the credit score that you want, one of the biggest ways you can improve that is making on-time payment history. And if, let's say, you are making on-time payment history, the next biggest factor in how your credit score is determined is your amounts owed. Are your credit cards, do they have a high balance? Is your debt to income ratio high? And by debt to income ratio is, do you have more money coming out than you have coming in? Do you have more debt that you owe than you have coming in that you can actually manage comfortably? A great way to do that is to honestly slowly pay it down with time. Currently in this place of inflation right now with this very strange economy, we might be racking up extra high credit card debt. And that is a fact, and it could potentially negatively impact your score if it happens too quickly. You're not able to make those payments on time. I also want to mention some credit cards have variable interest rates. And what I mean by that is that the rate will actually go up and down depending on what's going on in the economy and your payment history. Some scores are dependent on the Fed prime rate, and that's a bit more technical. But what that means is as the rates go up, your actual credit card interest rate may also be increasing directly correlated to inflation. You definitely want to keep an eye on that. And we'll talk about the specifics and intricacies of what makes up a credit card disclosure statement later. Next up is length of credit history. So this factor really is time. Um, if you had a credit card when you first got when you were 18 and you've had it now for the next 20, 30, 40 years, what have you, that's going to be your longest credit card and it's going to have the most credit history. If you're a bit on the if you're fresh out and you're not fresh out, but if you're a bit younger and you don't have or you have not had credit for as long as some of your counterparts, you really can't do too much about it. You just have to wait. This is really more of a waiting game. It establishes itself over time. And what I really want to recommend is not to close your longest account. Um, that's going to be your foundation, whether it's a credit card or even auto loan. You don't, unless you refinance credit cards, you really want to keep those especially if it's your longest one, but other things you can refinance. There's also credit mix. Credit mix is your installment loans, your revolving loans, still maybe structured loans. But what that means is, do you have an auto loan? Do you also have a mortgage? Do you also have a credit card? Do you have a couple of store
Student loans.
cards? Student loans, definitely. Having a good mix of them will show that you're able to manage multiple debts wisely. However, if you only have one credit card and an auto loan, I am not recommending to go out there and get a whole bunch of different loans to have a good credit mix. No, this is only 10%. Very, very minimal, not the most impactful, but it does impact you. If you're looking to say what you should do, I would say 100% get that payment history up to 100% if it's not. And if you also can get that amounts owed down to 30%. 30% utilization. Really pay down those debts if you have the ability to do so. And the last 10% is new credit. This is going to be your new inquiries and any new credit cards that you've opened recently. Also, while I'm going through this presentation, please feel free to add questions into the chat. We'll be more than happy to answer them at the end. And I want to ensure that this presentation gives you the most valuable as I can possibly offer to ensure that we are all taking this financial journey together and we get to our financial goals in one piece while maintaining some level of happiness and like a little bit of splurging here and there. We got to have some fun, right?
Yes, the Q&A, put your questions in the Q&A.
Um, Next up is the Vantage score. Now, this is different from your FICO score. Vantage score it's gonna have a little bit difference of the what's impactful. Extremely influential, you're gonna have your payment history. Again, making sure you pay your bills on time. The most influential thing you can do to increase your credit score is have an on-time payment history. Next is age and type of credit, along with percentage of credit limit used. So it's helpful to maintain a mix of credit accounts, credit cards, auto mortgage over time to improve your score, and focus on keeping revolving balances low, under 30% of credit limits. And this right here, this is key and this is crucial. This is going to be those credit cards, those store cards, whatever it is, keeping it under 30%. And by 30%, I say, let's say you have a credit card and the limit is 1,000. You don't want to hit that 1,000 every single month. You want to only utilize $300. And you never want to go above that. And you still want to pay it off in full every month, but that is that 30% of the limit used. Because if you start to max it out and you automatically do that, it shows that you're not having good credit utilization history and you're not really making the best of it. It seems like it's it does not show well to lenders, is what I'm trying to say.
And on top
You
of it, they're making money off of you with the high interest rates because you're paying more than say you know that then you say you purchase something for $500, you end up paying like 1,000 for it in interest rates.
Oh, perfect. Exactly that. Also, moderately influential is total balances in debt. As I mentioned before, with the FICO score, is you really want to ensure that you are staying well below your limit. And I do want to mention the FICO score and Vantage score are different entities, and different credit cards might use different FICO scores, Vantage scores, and sometimes this is just what kind of I know personally for me, from my credit card, I can see my score right in the app, which is great. It's probably a snapshot of a Vantage score or FICO score.
And I put the
Um,
link in the chat for you.
Thank you so much, Dominique.
You're welcome.
Um, Now, this is a sample credit score. Let's take a look at this a little bit more deeply. It's currently has a FICO score of 488, not the highest. This is definitely on the lower side. And when you're looking at it, you can definitely you'll see some of the codes and the score factor description. This is definitely useful in determining how your score got to be what it is now and what you can actually do to improve it. So this right here, serious delinquency. This example, this person did not make their payments on time. Their payment history wasn't the best, and it led to serious delinquency. Um, Number of accounts with delinquency. Now this says there's more than one account that has serious delinquency, which is not good. This could be that their auto loan is seriously delinquent. Maybe a couple credit cards are also seriously delinquent. By delinquent, I mean more than 90 days of not making a payment. And now it's starting to really impact their credit score. It's letting lenders know, hey, this person may not be the best person to lend to right now.
And you remember the example I used of a young lady I used to work with, and she would just use your credit cards and max them out and never paid. And as soon as she paid, she saw the difference in terms of where her credit score was. Like it just started to improve because she made those on-time payments, which I didn't, she didn't understand the impact that it was having on her credit score.
Thank you.
Mhm.
There's also ratio of balance to limit on bank revolving or other revolving accounts too high. Now, what this is, hey, this person is using all of their limit all of the time, and they're always at the max. They may not be they may be making payments on time, they may not be making payments on time, but whatever they're doing, they're utilizing 100% of it, and that's way, way too high. And time since delinquency is too recent or unknown. So that means they had a serious delinquency probably in the last 30 days, maybe in the last 90 days. And because of that, it really just says, hey, you know what? Right now, this person is not utilizing credit in a responsible way. And it may not be in your best interest to lend to them as a lender. Now, in this example, Dominic, do you want to go through this one?
Sure. This example, it could have been even the same person. So see the huge improvement. So the credit score is, from the FICO score is 8. So it's 656. So that person could have said, you know what? Let me stop making those payments. So, but it's still not where it should be in terms of the higher end, but you can see there's a huge improvement from what Terrence was previously talking about. So, but some of the stuff that's impacting the score and making it the way it is lack of a revolving credit account information. And they want to see, is there a collection? There's a derogatory public record. There's a collection on file. So that definitely having an impact on this particular score. And then too few, accounts that are currently being paid on time. And of course, there's not any recent revolving balances to kind of really counter and make sure and checks and balances. But there's definitely a huge improvement from the one that Terrence had to what this is right now.
Yes. And also a 656 credit score, it's not necessarily a bad credit score. You're right in the middle. As somebody mentioned, not in that 700, 800 plus range, but this is not typically a bad credit score. This is very average, very median. Most people do have a score like this or in the range of score like this. For this right here, no recent rolling balances. I do want to highlight, this is okay. This just means that there's no new credit lines that have been opened recently. And honestly, if I saw this in my credit report, I would not take this and say, okay, I need to now open 2 to 3 different credit cards. No, by all means, not at all. I would 100% most likely tackle the collection filed and the 2 few accounts currently paid as agreed. Again, this is going to be that payment history, that collection, and I wouldn't worry too much about the lack of recent revolving account information, but 100% payment history and ensuring that everything is paid as agreed. Now, for this one, we're going to get that 748, that 750. This is a top tier credit score. However, what you do notice, it says too few accounts currently paid as agreed. So this credit score note could have been added a long time ago, and it will stay on the account even though this person has been able to repair that credit score and get things back where they should be. There's also lack of recent installment loan information. Maybe this person paid off a lot of their loans, and you know what? They're not opening new ones because they're in a better financial situation. Again, some of these notes may not directly be like, oh, this is negative, I need to fix it right now, but there is information to show the lender this is what's going on, this is what happened in the past. Time since most recent account opening is too short. Again, some of these notes, they'll be added to your credit report when you had that 588 or that 650, and they honestly still might stay with you once you've reached that 748, 800 credit score. It does not mean that they are currently impacting you, but at one point in time, they did. Now, some options to improve your credit score. Dominic, do you want to kick off with this one and I'll come in at the end?
Sure. You want to make sure you know the difference between a secured and versus an unsecured credit card. So there could be credit cards, perhaps in your financial institution, here at the credit union, that will help you build your credit, especially if you have not had credit card, because you want to make sure that unsecured, for example, like the Visas and MasterCard, like Citibank, they'll give me a limit of $5,000. That's unsecured, but the secured one, it could say they give you a certain limit. It could be $1,000 just to kind of help you build your credit. So, and they see, okay, Dominique is paying on time. She's making her payments and every single month, and she's not going all the way up to $900 where the limit is 1,000. She's really just kind of staying the course and trying to really build up her credit. Then there's also some certain special loans, like we have some personal loans here at the credit union with lower interest rates that can actually help you pay off some of these credit cards that are at a higher rate, and then you end up just paying one payment a month. So that's also helpful. And it could be here at the credit union or other financial institutions, and they'll have that special credit builder loan just to kind of help you get on your feet. So I have a friend who was just paying here, there, everywhere, all these different credit cards, but it wasn't really making a dent in terms of the credit cards that he had. Once he took out a personal loan, actually here with the credit union, he was able to just make one payment a month. And that also drastically helped with his credit score going up. And then he didn't have to pay the higher interest rates. These different credit cards were basically just going after him, like 24%, 28%. That's a lot, and it just adds up and adds up and adds up. Terrence?
Yeah. Yes. I also want to add a bit more about the secured versus unsecured cards. Secured versus unsecured, the main difference between them is the collateral. Unsecured cards have no collateral backing them up. They are offered by the lender to just say, hey, yep, this is yours. Please use it wisely. Versus secured card, where there is the security of the collateral is the money that you have placed into the credit card. So it's your capital, and the credit limit is how much money you have set aside into that credit card. So it's 100%, whatever happens, it is your money. And it is offered to build credit, especially if you don't have any credit at that point. There's also special credit builder loans or debt consolidation loans, which could potentially have lower interest rate than these unsecured credit cards. And these unsecured credit cards can come at 18 to 20 to 26%, and they are very, very high. I 100% would want to look into that. Sometimes there's perks associated with a credit card that could justify the higher interest rate or the higher annual fee, but that really comes down to the person. And if you're looking for one-on-one financial counseling, please contact GreenPath. I have placed their link in the chat. I can do that again, but they are a great financial resource that we offer completely free to our membership.
And they're located at Central Time, and so you can call them even on the weekends, and they have access to about 150 different languages to assist you.
Awesome. And now choosing a credit card. There's a lot of options out there when it comes to choosing a credit card, and there's a lot of options out there when it comes to choosing the right credit card. Many different places will try to get you to choose their credit card and say, oh, we have the best rates, we have the lowest annual fees, and all they're doing is trying their best to get you to sign up with them and potentially get you into something that you may not be ready for. So as we talked about earlier, interest rates and interest charges, the APR, some lenders and some credit cards will offer what's called a 0.0% intro APR for the first 12 billing cycles from the date of account opening. Wow, that's a lot. What does this mean? This means for the first 12 months, 12 billing cycles, you'll have 0% annual interest rate. And what this does is sometimes it allows for a balance transfer, or it's kind of almost like a bait and switch, where for the first year you've been making payments, everything's fine, and you're like, oh, this is great. Then after that, your APR, your intro APR expires. Your APR will be anywhere from 11.74% to 17.99% based on your credit worthiness. This word right here, credit worthiness, this is what is determined, or what they use to say, what's your credit score? If your credit score is on the lower side, on the 500s, you might actually be in that, higher interest rate. If you got a 700, maybe that really, really great credit score, you have that lower interest rate, 11.74%. Another factor to be mindful of is what your balance is at the end of the introductory period, because that balance will now be subject to whatever the APR is. That 13th billing cycle, let's say it was a $10,000 credit card and you had at the max limit, and all of a sudden something happened, a flat tire, what have you, and you weren't able to pay off that balance in full on time, and you are suddenly subject to 11.11% or 17% APR, now you're paying interest off on $10,000. That could be financially detrimental, especially if you're not expecting it. Oops. And this APR will vary with the market-based prime rate. I mentioned that earlier. Oops. This market-based prime rate is what's going on in the market right now. It's the Fed's raising interest rate, and what happens is your interest rate is the Fed prime rate plus or minus a certain amount of interest on top of that, so that way the lender could possibly make money as well. This is a little bit tricky, and I would 100% would challenge everybody here on this call to take a look to see what was happening when it was first disclosed to you, and how can you possibly be mindful of it and maybe even get a reduced rate if it's available. Next up is the APR for cash advances. This is the annual percentage rate for cash taken out from the ATM. Some credit cards offer the ability to remove cash from them. While it's not cash, it's not a debit card, it's a credit card, you can take out cash from an ATM. And that sometimes those specific transactions are subject to their own interest rate and their own variable APR. So that is another factor that could potentially impact you.
And I say, don't do it. I did it once. And I ended up paying more than the money I took out. I think it was like $100, and I regretted it. I was like, I could have just gone to my ATM and just waited and just taken it out of my checking account, because I ended up paying more. It's not worth the interest rate. Don't do it.
Perfect. That you're exactly right. They are it's advertised as a convenience for the user. However, it can be very, very quickly and very, very dangerous, because at the end of the month, you're seeing this interest charge for, as Dominic mentioned, $100, and now it's being charged 18%. What happened to that? Where did that go?
It's the trick.
Yeah. Next up is the APR for balance transfers. So this is what I talked about earlier. Balance transfers, this is another tricky trap set by the credit card companies or the lender, where let's say you have a high interest credit card of, I'm just going to name a bank, let's say Bank of America, right? And they're charging you 21%, just for numbers sake. And you know what? You say, I can't keep doing this, 21%, it's way too high. And you decide to transfer your balance to a different credit card company because they offered 0.0% APR for the first 12 billing cycles. And that's great. And you say, you know what? I can pay this balance off. I'm going to be fine. I'm going to do it in a year and I'm okay. But throughout that year, something might have happened. You missed a payment, and now you didn't actually fully pay off the balance in full, or you actually were also using that same credit card to finance your same purchases. So not only are you transferring over the balance that you had initially, you've also increased your balance. And now once the APR expires, you're subject to the 11.74, 17.99% all over again. And this is where a lot of consumers fall into the credit trap, where you're stuck paying interest over and over and over again. And we have other presentations that go into this a bit more, but a quick aside to that is those monthly payments that you're making every month, the majority of them are going towards paying off the interest. About 70 to 80% of your payment is comprised of interest only. And what that means is, let's say I'm making my monthly payment is $100 per month. $80 of that $100 is going towards interest, and $20 is only going towards principal, which actually is what my balance is and how I pay that down. Very, very good piece of information. And you want to see how much of my payment per month is being applied towards the interest how much of a payment per month is being applied towards the principal, the actual balance that I'm paying down. Because if you don't actually pay down the balance, you'll keep being charged interest in a vicious cycle and you'll never get out of it. So, interest, we've learned we don't want to pay that to the lender. How do we avoid paying interest on purchases? The best way to do that is your due date is at least 25 days after the close of each billing cycle. And if you pay it off in full, you will not be charged any interest on purchases. That's the best way to do it. Pay it off in full at the end of every single month. Now, I did see a question come in, and we'll talk about that now. The question is it wrong to max out your credit line if you're still paying it off 100% at the end of the month and not being late? So first off, I would not recommend utilizing it 100% only because there's flat tires, something could potentially happen, and emergencies do come up. And the last thing you want is for you not to be able to make that payment in full. And all of a sudden now it's being transferred over to next month and you're charged 18% on it. And it
Or
could
more.
or more. And it could quickly send you into a downward spiral. The same thing can happen when it's only utilizing 30%, but it's going to be less impactful on your credit score, your credit report, and that utilization. All it takes is 1 month for it to report that, hey, you're at 100% when for the past, I don't know, 5 years, you've been
6
at
months.
30%, 6 months.
Right.
Now, what happened? And your score could tank, and that could potentially take some time to rebuild that up again. Also, the second part of the question is also, does minimum payment affect your overall credit in a negative way? The minimum payment does not overall impact your credit in a negative way. That is your only obligation to pay to the lender, that minimum payment. And as long as you pay that bare minimum amount, you will be okay. But as we discussed earlier, it may not actually be bringing down your principal. That bare minimum amount might actually be only like 90% interest and only 10% principal. So for the time that you have this card, you could just be paying interest on your purchases. And for more tips about this, please visit www.consumerfinance.gov to learn more. We'll be putting that link in the chat shortly. But I hope this presentation, I know this slide was a lot. It was very dense, very heavy, but this is very, very crucial information to learn about and to be mindful of so that way you can take charge of your borrowing. You want to be an active borrower. I mentioned that a lot throughout my presentations. And if you've been with me for a little while, you know I'm a big, big, big believer in being an active borrower and not a passive borrower. Don't just take whatever that lender gives you as fact. Do your research, shop around, and make that lender work for you and work for your money. Next up, fees. There are some fees associated with some credit cards. In this particular example, there's none, but the annual fee is separate from the interest. It's separate from your payment. It actually is a fee just to have the card. Now, some cards, depending on the perks, have higher annual fees, like the Chase Sapphire, maybe some travel cards, your Amex. These cards have substantial annual fees, sometimes up to 700, 900 bucks, and you pay them. Sometimes they're broken up into monthly payments, or sometimes they're all at once at the end of the year. And the reason why they offer these annual fees is because their card comes with significant perks and rewards that are not typical or traditional. That could be points on flying back or travel points, maybe upgrades for hotels, automatic upgrades for car rental places, certain amount of extra high cash back on dining out or foreign transaction fees. There's a lot of different things that could justify the reason for an annual fee, but you want to be aware of it. That's the main thing, being fully aware of the annual fee that you're paying and ensuring that, you know what, I'm comfortable with this because I get some good perks. And if you're not getting good perks and you're paying an annual fee, ask and say, you know what, is this really useful to me? Maybe I want to get a new card. There's also transaction fees, balance transfers. Again, another potential trap, 2%. Sometimes just that transaction of taking one balance of one card and transferring over to another one, even if it has 0% APR, that that balance transfer, that transaction itself could come with a 2% fee of the balance transferred. Another fee that the credit card company will impose on you just for using the card. Cash advances, with this one, there's none. That does not mean this represents all of them. This is just a concept, just a quick showing to say, hey, this is here. There's also foreign transaction fees. This, I'm not gonna lie, I got hit with this when I took a trip to Canada. I went up to Niagara Falls and I quickly drove over the border. It wasn't a big deal. I had my passport and everything, but I did a bit of shopping, and on my credit card statement, I saw those fees and I said, whoa, that was crazy. I'm not doing that again. And it does add up very, very quickly, especially if interest is then added onto it. There's also payment penalty fees, late payment fees, return check fee. These are if you did not make a payment on time, or you were a little bit late, or you didn't pay it off in full before the statement closing date, there's a late payment fee. The return check fee is if you authorize a payment to your credit card and it doesn't actually go through for whatever reason. Maybe it's an insufficient funds, or your lender did not authorize a payment to go out, or for whatever reason have you. That fee, $4.50. This is on the lower side. I have seen them be as high as $10, some as high as $40. And these fees are not going to be charged to you separately. They're just going to be tacked onto your balance with the credit card. There's also the replacement card fee, $15 to get a new card, and emergency replacement card fee. This is to have your replacement card expedited and shipped out to you quickly within 2 to 3 business days. So there's a lot of hidden fees associated with this that can potentially put you in a different financial situation than you originally thought you would be in when you first signed up for the card. I know that was a lot. Anything else you want to add, Dominique? I kind of took over that for a little bit.
No, it's fine. It's yeah, you want to make sure that you're not paying for these extra fees. I personally don't like to have credit cards where I have to pay an annual fee because I'm like, what's in it for me? So I don't want to give them any more of my money.
Ooh, and I think we are running a little bit over, so I'm gonna rush through this kind of quick. If you are looking to opt out, please visit optoutpressscreen.com. So that's if you don't want any more of these, any fees, you don't want to receive the flyers from different credit card bureaus or different credit card companies and offers. You do have to shred those because they have very personal identifying information on that. So if you don't want to receive those credit card offers, visit optoutprescreen.com.
I have
And
the link in the chat.
oh, perfect. Thank you so much.
Mhm.
Again, we talked about GreenPath free financial counseling. It's a great resource that I offer completely free of charge. That's huecu.org/greenpath. We also have a smart reward savings account that's new. It's no fees. It's and you can earn 4% in interest. So that's money coming back to you per year. We also have a blog at HUECU, a blog.huecu.org, where we post often. Every 3 or 4 days or so, we ensure to have a new blog post up there. And full disclaimer, this presentation is a general overview. Please don't sue us, just as a joke. We are offering this information to be educational and conceptual in nature. This is not specific financial advice for your situation. If you have any specific questions, please consult a certified financial advisor. At the end, yes, please keep in touch. We are at myhuecu on all social channels. If there's any other questions in the chat, please feel free. I'm here, and I apologize that we went about 3 minutes over.
And Wendy, do you want to add anything?
Yes, thank you for that great presentation, Terence and Dominic. Hi, I am Wendy Mateo Arias. I work at the Workforce Development Program in Human Resources, and I am just coming to represent the benefits area. This financial well-being program with Harvard University, the Employee Credit Union is just one of the few initiatives that the hospital has started to just support our employees in different areas than just work. So we have great financial topics from all different levels. I hope that you like this presentation, and they're all recorded on the website. I will be emailing that to all of you, and you can feel free to watch those recordings and join us in any other topic that you might like. Thank you very much for joining us today.
All right, thank you, everyone. Have a great afternoon.
Thank you, everyone. Bye.
Bye-bye.